What's up, YouTube? Welcome back to another video. Welcome back to another informational banger. So recently I posted on my Instagram. If you're not following my Instagram, follow my Instagram, right? C Snipes Official. I posted a question asking what's the biggest thing that my followers are struggling with right now. I had a response about market structure, and that's what I'm covering. That's what I'm covering right now. Is market structure. Okay, market structure is going to be the most important thing when it comes to your analysis. It's just giving you that direction. You want to know overall what is the probability of who's in control of the market, buyers or sellers. That is mainly the reason for market structure and why we want to respect market structure. If you don't have an insight of where the market has been going or where it wants to go, then it's going to be hard when you get on the lower time frames, trade the lower time frames, not knowing the higher time frame direction. Okay, so when I say this, we have three types of directional bias that we look for. As far as what I teach in my mentorship, we have higher time frame, so higher time frame direction. We have intraday direction, intraday, and then we have lower time frame direction. And if I was going to give you guys a time frame for this would be 4 hour and up, right? Intraday would be 1 hour. This is usually what I'm looking for, is the 1 hour when I'm looking at intraday. And lower time frame is going to be below the 1 hour. So usually 30 minutes to like 15 minutes to 30 minutes is usually our lower time frame, what we're looking for as far as our lower time frame legs. Okay, so these are the time frames. Now, it's not specific to these time frames, but these are the average, right? Usually it's 4 hour or up, so 4 hour daily, weekly, and then intraday would be 1 hour, between the 1 hour, 2 hour, and a lower time frame would be underneath the 1 hour. Okay, that is usually how I would look at these three different directional types. So why is this important? Market structure is important because it's going to give you the direction and it's going to tell you who's in control of the current market. So for example, here we're going to use EU. Now EU here, we can see we have a bearish leg. So I'm on the 4 hour time frame right here. You can see we have a bearish leg to the downside. This is something that we need to understand, is we have a bearish leg on the higher time frame. Now, we're not trading this higher time frame, but this gives us the idea of where we are going on the higher time frame. If we have a bearish leg on the higher time frame, we keep that in mind. Keep in mind, we're not trading the higher time frames though. For example, why is this important that we know that we are in a bearish leg on the 4 hour? Okay, so let's use the playback feature here, and we're gonna go to right here as to why that is important. We're gonna skip out all of this. So as the market was doing this and we were going down, right? We were going down to the downside, and we seen this 4 hour leg to the downside. Now, mind you, inside of this, we have the intraday time frame, we have the lower time frame. Okay, so we teach multi-time frame analysis. We have the intraday and we have the lower time frame inside of this. So what would you say is the intraday? You see these legs to the downside here are the intraday legs going to the downside. Okay, now what I want you to pay attention to is, as soon as we made that higher time frame leg to the downside from this high to this low, and we broke these lows here, making this a bearish leg, we know that from this high to this low is where the market wants to come back and try to fill up most of this leg here. What does that mean? That means now, once this leg has been completed, and we know the leg has been completed as soon as we start getting a reversal here. Once we start seeing those reversals here, we know that once I go to the 1 hour here on the intraday time frame, as soon as we break this high here, we can see this intraday going higher. You can see this high makes this low, making this high, makes this low, making this high, makes this low, making this high, makes this low, right? Making this high here. So now We know the 4-hour is bearish. We know we have a 4-hour bearish leg, but on the intraday time frame, we have bullish legs going on. What do we do in that case? Well, this is where the multi-time frame becomes very important in understanding where you are. This is why we look at higher time frame direction, intraday direction, and lower time frame direction, so we know where we are at in the market. What does that mean? So as this 4-hour leg, this huge leg to the downside on the higher time frame, what we usually do is we will do something like this. We will draw out our fibs, and we know that beneath our fibs here, most likely than not, we're gonna have low probability sellers. So what does that mean? That means as soon as this market starts retracing towards the upside here, we can start looking for buys inside of this box right here. Why? The reason why is because we are at discounted pricing. We know if we are in a bearish market, because from this side to this low, we have a bearish leg, we know that the market most likely, we're going to get the highest probability for sellers at the premium prices. And what is premium? Premium is above the 50%. So here would be premium pricing up here. Down here is discounted pricing. We know if we're a seller, we want to sell at higher prices, right? We want the best price to sell our product if we're going to sell something, right? We want it to reach to the highest prices so we can get the most money. That's the same mindset here that we're going to have in this bearish leg. We know that if we want to sell this market, the highest probability for these sales is going to be above the 50%. What does that mean? That means once we go to the intraday time frame, even though we know the higher time frame here is bearish, when we go to the intraday time frame and we start seeing this market create these new legs towards the upside, as you can see here on the 1 hour, the more I zoom in here, this is the intraday 1 hour, you can see these new legs to the upside. We can start to buy this market. We can start to buy this. We can start to buy these legs, right? We can start looking for buys here, taking this bullish intraday towards the upside until we get into premium pricing. Once we get into premium pricing, this is where we start becoming cautious with our buys. Why? Because now we know that, hey, okay, the market made this new leg to the downside on the higher time frame, and we know what the market does. The market always pulls back. We always retrace, right? So once the market retraces and we start seeing that it starts switching structure, so this is where the multi-time frame structure becomes important, because as you can see, as the market was going down on this huge leg on the internal, we can see we have bearish, 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 right? But as soon as we made this leg and we got a high, we got a low, we can see the internal structure, which is our intraday, starts switching to bullish. So now that gives us the ability to follow that price action, because we know the market is most likely going to give us the highest probability sales once we get back into premium pricing. That gives us the confidence to look for buying opportunities down here. Once we see that intraday structure starts going bullish, we know we can ride that bullish tide towards the upside until we get to premium. Now, once we get to the premium, we know that, hey, higher time frame is bearish and we are reaching higher time frame premium prices. So now we start becoming cautious on the buys and we start looking for the sells. We ask ourselves, where is sellers at? Where is our points of interest? Where do we have manipulations and everything like that? And as you guys can see here, look at where we're reacting. Okay, look at these supply zones above the 50%. Okay, we have manipulation of liquidity here. I'm gonna kind of zoom into that for you guys and show you guys why I picked this. So we have manipulation of liquidity right here. That is above the 50%, and look where the market respects, right? Look where we respect this area. We were definitely looking for sales here, right? We were definitely looking for sales right here to take this to the downside. As you can see, the market is still respecting the intraday. If the market is still respecting the intraday, we will continue trading this intraday until we break the intraday cycle, right? That's why multi-time frame is important. We know we can very much look for sales up here, but we're not completely being aggressive with sellers until we invalidate this intraday, right? As you can see, we're going to see that happen and why we're being aggressive with sales right now. But I just want to give you guys the mindset as to how we're looking at, the different structures. Okay. Going from just this one leg, well, all we're referencing is this one leg. Okay. All we're referencing is this one higher time frame leg. And we're looking on the internal structure within it, which is the intraday and the lower time frame. Right now, we're just focused on the intraday since it's much simpler. So we're just focused on higher time frame and intraday time frame right now. It's going to be much simpler that way. Lower time frame gets more deeper into it, as you can see, like these little these little more internal legs on the inside of it. But the main things we need to focus on here is higher time frame and intraday. If you can get these two down packed and you can understand this, then lower time frame is just going to be easier. Okay, so we have this higher time frame to the downside. We know that we want to look for buys once the market is showing us this intraday is bullish. Even though we know higher time frame is bearish, we can still take this intraday bullish towards the upside until we get into supply zones here. That's when we'll start looking for sales, because we are back in premium pricing, and we know we know that higher time frame is bigger than intraday time frame. So what does that mean? Higher time frame is going to have a higher probability than intraday time frame. So once we get into higher time frame supply zones, such as this area right here, we're going to be looking for sales. As you can see right here, we have a good reaction to the downside. But what do you see? The market is just filling in balance, mitigating the intraday that we have going up and going higher. That is okay. Okay, that is okay. What do we do in that scenario? We continue following this intraday. Even though we know that we are in premium pricing, we can still continue following this intraday until it gets invalidated. Once this intraday gets invalidated, then we know now the market is aligning itself back with the higher time frame. Once we see that intraday and higher time frame are going in the same direction, for example, right here, we can see higher time frame is a bearish leg, and now we're retracing. So that means on the internal, we have the intraday right here. You can see intraday is going higher, low, high, low, high, low, high, low, high. And you can see as we're going higher, we are mitigating these supply zones and we're getting reactions from it. Now you can see we mitigated this first supply zone. We got a reaction. We went higher. We mitigated this next supply zone. And this supply zone right here, we can say had more sellers. We had more aggression within the sellers on this supply zone. Why can we say that? Because we can see this supply zone caused us to break the intraday, right? This supply zone caused us to break this intraday low. What does that tell us? Now we know that, hey, higher time frame is bearish and now intraday is bearish. What does that tell us? Now we know we can start being aggressive with sellers, because now we have higher time frame and intraday time frame going in the same direction. We know that sellers are in control of this market, and now we can start following this intraday to the downside, as you guys can see here. Now we can start following that internal until we do what? Until we make a new low, right? So now we will have high, low, high, low being our new higher time frame leg. So now this would be our current higher time frame legs going to the downside, as you guys can see there. So hopefully I was able to explain this well enough for you guys to understand. I wanted to give you this quick breakdown using EU. So this is what we mean when we trade multi-time frame. If you want some more depth explanation on this, you can join my mentorship, or I do have another video on this already that I kind of explain multi-time frame analysis. But if you want the depth, the more in-depth and the more breakdowns, it's going to be in the mentorship community, honestly. But like I said, I did break this down on YouTube already. in my older videos, but I wanted to kind of touch upon it again for you guys to give you a little bit more insight on it, and hopefully I was able to explain it and simplify it a little bit more this time so you can get the grasp of it. It's really this simple. There's really nothing more into it. Now you're just gonna have to apply that same concept from like intraday to lower time frame. I wanted to give you guys the higher time frame versus the intraday because those are the most two important time frames that I focus on, is higher time frame and intraday, and then I'll use my lower time frame for entries as far as POIs and things like that. If I need to make a part 2 on this and I'll cover a different pair for you guys, let me know in the comments. I will, use the same concept and cover a different pair just to give you guys another example. All right, so please let me know what you guys think. I will see you guys in the next one. Peace out.